All right, let's jump right into Ambev's Q3 earnings. Now, this one's a bit of a head-scratcher. On the surface, the numbers looked, well, a little shaky, but the market, it absolutely loved it. So the big question is, what did Wall Street see that maybe the rest of us missed? Let's dig in and figure it out.
So here's the core puzzle we're trying to solve. You've got a revenue miss. That's usually bad news, right? But instead of the stock taking a hit, it popped over 5% on the day. That just doesn't add up at first glance. So yeah, what gives? That's exactly what we're going to unpack.
Okay, so to really get what's going on, we've got to start with the headline numbers. Let's see what everyone was looking at.
Okay, so right off the bat, you see the revenue miss. They brought in $3.83 billion when the street was looking for $3.97 billion. Not great. But then, look at the bottom line. Adjusted earnings per share, or EPS, came in at 4 cents. That's exactly what analysts were expecting. So that's our first clue that there's more to this story than just the top line.
And that's the key right there. The market, the smart money, they basically just shrugged off that revenue miss. They looked right past it and honed in on what was happening underneath. They found 3 key things that painted a much more optimistic picture.
First up, and this one is a big one, profitability. Net profit just exploded, jumping over 36% from last year to 4.86 billion Brazilian reals. We're not just talking about a beat here. This crushed what analysts were expecting. It was a total blowout, and that screams powerful earnings.
Number 2, margin discipline. Now get this, their sales volume actually fell by almost 6%, but even with that, they managed to expand their adjusted EBITDA margin by 50 basis points. That's half a percentage point. How do you do that? It shows incredible cost control and serious pricing power. It proves they can defend their profits even when things are slow.
And the third big piece of the puzzle was a huge signal of confidence directly from management. They announced a brand new share buyback program for up to 2.5 billion reais. When a company does that, it's basically shouting from the rooftops that they're expecting a ton of cash to come in and that they think their own stock is a bargain. That gets investors excited.
Okay, so when you put all that together, you start to see the real story emerge from behind the headlines. It's not just about growth anymore. It's about something else entirely, resilience.
This quarter was a classic tale of two opposing forces. On one side, you had all the stuff they couldn't control. The whole industry was soft, the weather was bad, and of course, that meant volumes were down. But on the other side, Ambev absolutely nailed everything they could control. We're talking strong pricing, leaning on their popular premium brands, and just really tight, disciplined cost control.
And you don't have to take my word for it. Just look at what the CEO himself, Carlos Lisboa, said. He didn't come out talking about trying to grow volume. Nope. The first thing he highlighted was delivering EBITDA growth and margin expansion. See? That's the pivot. That's the new story that investors are really latching onto.
So what we're seeing here isn't just one good quarter. It really signals a major shift in the whole investment case for Ambev.
Here's the big takeaway for anyone looking at this stock. This story is changing. It's not about when will sales volumes recover anymore. Now it's about look at these strong margins generating tons of cash that they're giving back to us. It's a pivot from chasing growth to defending profits and rewarding shareholders. Think of it as a more mature, defensive, and frankly, shareholder-friendly company.
And this chart really puts that defensive idea into perspective. Take a look. Over the last year, sure, Ambev has lagged the wider Brazilian market, which, to be fair, has been on fire. But here's the interesting part. It's totally crushed its peers, the other big global consumer staples companies. So it's acting exactly like a classic defensive stock should, holding up strong while the rest of its sector's taking a hit.
All right, so with all that in mind, what does this mean for Q4? What should we be looking for as we head toward the end of the year?
This is where we get to the next call. Based on everything we've seen, here's our take on what's coming.
For the results, we're calling for more of the same. The story's going to be continued pressure on volumes, but that'll be offset by their strong pricing power, which should keep margins looking pretty stable. Oh, and one thing to watch, that super low tax rate in Q3 was a one-time thing, so expect that to pop back up to normal levels. Now, what about the stock? We think it's going to trade sideways. The buyback should act as a nice floor, keeping it from falling too far, but all the broader economic headwinds will probably put a cap on any big moves up.
So putting it all together, we're giving this some market perform rating. Look, the company is doing an excellent job navigating a really tough environment, which makes it a solid hold. But we just don't see a catalyst for major outperformance until the entire industry starts to see a real recovery in sales volume.
And, as always, just a quick reminder, this is for informational purposes only. It is not financial advice.